Good morning and welcome to the Post-Monetary Policy Committee press conference for the month of August 2023. The Monetary Policy Committee met yesterday, the 9th of August, and issued its usual press release. And as is customary, we are here to hear from the Governor of the Central Bank of Kenya, who's also the chair of the MPC. He will take us through his thoughts and the statements, and then we'll come back and take your questions and answers. As you do so, please go through Slido. That's the usual place, www.slido.com. The meeting ID is #MPC0823. And as a reminder, please make sure you include your name and your institution as you ask your question. So without further ado, I'd like to introduce and welcome the Governor of the Central Bank of Kenya, Dr. Kamau Thugge.
Thank you very much, Wallace. During its meeting on August 9, 2023, the Monetary Policy Committee retained the central bank rate at 10.5%. The MPC noted that inflation is already within the target band and is expected to decline further as food inflation is expected to come down. They also noted that inflationary pressures had eased as non-food, non-fuel inflation had declined. And finally, that the impact of the tightening of monetary policy in June 2023 to anchor inflationary expectations was still transmitting in the economy. The committee will closely monitor the impact of these policy measures, as well as developments in the global as well as domestic economy, and stands ready to take further action as necessary. The committee will meet again in October 2023. Starting with the global developments, global inflation, the headline inflation rates have continued to ease in the major economies, but have remained above the respective targets with persistent core inflationary pressures. As you can see in the slide on the left-hand side, which shows the inflation rates of a few key economies, the US, UK, Eurozone, and China and India, you can see that the inflation for the US has declined quite significantly from around July of 2022, and is now about 3%. For the UK, inflation is about 7.9, which, as you may be aware, that is slightly higher than the inflation rate that we have as at 7.3%. And whereas the headline inflation rates have been coming down, the core inflation shown on the right-hand slide, the core inflation rates have remained elevated, with the exception of the China, where the core inflation rate is averaging about 0.8% around July. Now, the decline in that overall inflation can be explained by developments in oil prices, as well as the global food inflation. Melbourne oil price has declined from 130 US dollars per barrel in March of 2022 and is now around $88 per barrel. Similarly, with respect to global food inflation, the global food inflation has declined, and that can be seen in the blue line on the right-hand side of the right-hand slide, which has consistently been going down, and only around July it has ticked up a little bit. The main exception here is the sugar price inflation, although it has stabilized in June and July from the sharp rise in May following improved supply from harvests in Brazil and owing to sluggish global import demand. Now, turning to the global economic outlook, We've seen weaker global growth that is expected in 2023, and the outlook has been revised upward. It was actually worse. It had been expected that growth in 2023 would be about 2.8%, but that has now been revised upwards to 3%. Nonetheless, this is a deceleration in growth from 3.5 to 3%, and over the medium term, it has been projected to remain at 3%. The contributing factors to the slowdown in growth is mainly the advanced economies. The United States growth is expected to decelerate from 2.1 to 1.8%. And importantly, the United Kingdom's growth is expected to decelerate quite sharply from 4.1% last year to only 0.4%. For the emerging markets, we see a steady growth of 4.4 last year, which is retained for this year. But nonetheless, there are differences in growth rates within that sector, with China increasing growth from 3% to 5.2%, which is offset to a certain extent by the reduction in growth by India from 7.2 and 6.1. With respect to sub-Saharan Africa, we see again a slight deceleration in growth from 3.9 to 3.5, and that's mainly because of South Africa. But as you can see, in the last line, we do see an acceleration of growth for Kenya from 4.8% to 5%. That is the WIO estimate. We are estimating a bit of a higher GDP growth, but I'll come back to that shortly. With regard to domestic inflation, the overall inflation declined in July 2023, driven by lower food and non-fuel inflation. Looking at the very last slide, you can see that the non-fuel inflation has declined from 4.1 to 3.8%. Food has declined from 10.3% to 8.6%, and only fuel has increased from 12.9 to 14.5, reflecting some of the increase in fuel prices that we experienced during the month of July. In terms of the contribution to overall inflation, again, you can see that food comprises about 45% of the overall inflation at 3.3, followed by fuel, and then finally followed by the non-fuel. Just focusing now on the non-food and non-fuel inflation, which declined in July 2023, indicating easing underlying inflationary pressures attributed to monetary policy measures. And as you can see, there's been a steady increase in the non-food, non-fuel from around actually January of 2022, and that has been going and reached a peak of 4.4% in March, around February, March of this year, but has since trended down and is now at 3.8%. Focusing now on the main drivers of food inflation, we see the contribution of prices of vegetables and non-vegetable food items to food inflation declined with improved supply and lower global food prices. And just focusing again on the very last column, where again recall that food inflation was 8.6, and that comprised of 2.1 percentage points from vegetables, and a significant part of that, 6.5, was non-vegetables. In regard to the vegetables, in the next slide, you can see that most items are actually expected to decline. The orange bars are the July 2023, and the blue is June. And as you can see, for the most part, other than for onions and coriander leaves, most items are actually expected to decline in prices. In the case of onions, which is quite significant in the food basket, what we have seen is that there's been reduced imports from Tanzania, and at the same time there's been a poor harvest in Kenya, and there has been also some crop substitution, and that has caused an excess demand for the onions, whose price has increased quite significantly. With regard to the non-vegetable inflation and the contribution of prices of wheat, maize, milk, and edible oils to overall inflation has continued to ease with improved supply and lower global prices. From that chart, you can see that the contribution to inflation peaked around September of 2022, and since then there has been a gradual decline to the point where these four key items only now contribute 0.6 to the overall inflation. The one exception to that trend has been the sugar prices, which have remained elevated due to reduced supply. We also did take an agricultural sector survey in July 2023. And again, from the respondents, most felt that prices would continue to decline. You can see the vegetables prices will continue to decline, as well as some animal products. But non-vegetables, there was some doubt as where the price for non-vegetables would head to. Turning to the domestic economy, and looking again at the third column from the right, which shows the first quarter. I believe we focused on the first quarter last time, but the bottom line is that the growth in the first quarter was estimated at 5.3%, and that largely reflected the recovery in agriculture, up to the growth of 5.8%, compared to the contraction in value addition in agriculture of minus 1.6 in 2022. Maybe just skipping to the next slide, although I'll come back to this one. The next slide shows the leading indicators which point to a strong economic performance in the second quarter of 2023. And as you can see, what is in blue is a composite index of economic activity, and that has tended to track quite well the ultimate output and actual production. And what we are projecting to be growth in the second quarter is 5.6, which is at the very end of that slide. So coming back again to the previous chart, we see that the second quarter will grow by 5.6, and for the whole of 2023, we expect GDP to grow by 5.5, which I said is slightly higher than the World Economic Outlook projections by the IMF. Again, we expect a huge recovery in agriculture of 5.9%. But indeed, most sectors, we expect fairly robust growth, perhaps with the exception of manufacturing, which continues to show somewhat sluggish growth, and we've projected that it will grow by 2.7% this year. Of course, having said that, I am aware that in the budget there was a big focus on budgeting for value chains, and There were 9 value chains that were identified. There was textiles, there was leather, I think there was milk and rice as well. There was edible oils, and also the building materials arising from the housing, affordable housing program. And I do believe that once those value chains are implemented, we should be able to see a turnaround in manufacturing growth so that we reverse the steady decline in the share of manufacturing in GDP, which has taken place over the last few years. Again, just to focus on the agricultural production, we see the volume of horticultural exports, tea production and milk intakes have increased in 2023, and this has reflected the improved weather conditions. If you look at horticulture, we see the difference between 2023 and 2022. You can see the green bars indicate the growth rates, and again you can see even in June the exports of horticulture increased by 22.5%. Looking at tea, there has been a reversal. In the first quarter of the year, tea production did not do so well, but in April, May, there was a significant reversal, and we see tea production increasing. Similarly, for milk intakes, we had a fairly negative performance in the first quarter of 2023, but since then, we have seen in May and June a significant improvement in milk intakes. Again, just to highlight a few key food crops, starting with maize. The production last year in 2022 of maize was 34.3 million bags. Now we are estimating that production, because of the improved weather, that will increase to 47.8 million bags, translating to a 39.3% increase in maize production. Similarly for wheat, from 3 million bags to 4.9, an increase of 62.6. Rice, we have, there's a problem with rice with all the flooding, and so that is expected to not produce as much as we produced last year. And indeed, we expect reduction in rice production by 27%. But beans will increase by 105%, Irish potatoes by 26.3%, and sorghum by 150%. So we're quite bullish about the agricultural production given the improved weather conditions. With regard to tourism, tourist arrivals have remained strong in 2023, supported by a recovery in international travel. Again, just looking at the graph, you can see the green columns, which represent the growth rates between last year and this year. And you can see that even in June, the growth rate was 25.2%, and in January it was 67.3% compared to the previous year, January. Credit to the private sector has been trending upward, and you can see since March of 2022, for the first time in quite a long time, we've experienced now double-digit growth in credit to the private sector. It did peak at 13.2 in April and May. There was a slight decline in 12.2. But I believe this will pick up again, and I will come back to the issue of credit to the private sector. Just some examples of where credit to the private sector was going. In manufacturing, we see that in June, There was an 18% increase in credit to the private sector. In trade, it was 12.5. In transport and communication, it was almost 20%. And consumer durables also experienced an increase in credit to the private sector of 11.8. Turning to the balance of payments, although it may be difficult for you to read there, just to point out that exports, we expect exports to increase by about 6.7%, from $7.4 billion to about $7.9 billion. Just go back to the previous slide. On imports, we expect imports to remain broadly unchanged, maybe just 1.6 or roughly increase, but broadly unchanged. And therefore, from that, and we'll come and see the current account, so exports are growing at a faster rate than imports. We also expect significant capital inflows from foreign direct investment, portfolio investment, and other investments. And then by the end of the year, looking at the very last line and the second column from the right, if you look at the very bottom, we should be able to have a balance of payment surplus of 193 million, and that will carry over to the next year, where we'll also have a balance of payment surplus of 810. The current account, as I indicated, the outcome for 2022 was a deficit of 5.1% relative to GDP. In the year to June of 2023, we've seen that current account deficit narrowing to 4.2, and at the end of the year, we expect that we will record a deficit of 4.8, so that will be a narrowing from 5.1 the previous year. And again, that reflects the increase in exports, the slower increase in imports, good performance in remittances, which I will now come to. I think on the total goods exported, we've seen, as I indicated, for the year to June 2023, we see an increase in exports of 2.1%. From 7.1 billion to 7.3 billion. That's up to June. But as I said, for the full year up to December, we expect that increase from 2.1 to increase to 6.7 for exports, basically driven by tea and horticulture exports. Again, maybe just to indicate the contributions to the exports growth through June. You can see that it's manufactured goods. You can see manufactured goods are doing quite well in terms of exports through June, and similarly, the chemicals and related products are also doing well. So turning to imports, imports declined by 6.1% in the 12 months to June of 2023, compared to an increase of 20% last year. Again, overall, we expect imports to actually increase, but only slightly for the year. Again, that slower growth in imports and larger increase in exports will improve our trade balance and improve our current account, and ultimately is helping with the overall balance of payments surplus. Let me go to travel services. Let's go to travel services. Yes, travel services, they have remained strong in 2023, which reflects the improvement in international travel. And as you can see, the purple line, which represents the 2023, you can see that for January, for example, the purple line is longer than all the other lines, indicating that there was more travel receipts this year than the last 3 years. Similarly, for February, we have more receipts this year than for the last 3 years. And actually, all the way up to May is the case that this year's travel receipts have been higher than previous years. It is only in June whether there's a slight decline compared to last year. But overall, you can see that for the first half of the year, there's been significant inflows of travel receipts. With regard to remittances, this is where you can see that there's been a steady increase in remittances all the way from 2016 to 2023, and we crossed the 4 billion mark in June of 2022, and we have maintained that level at on June 2023. But nonetheless, it's still quite significant, although it hasn't grown as much. I believe for the rest of the year, we're actually expecting an increase of 8% between last year up to December and this year up to December. We should see an increase in remittances of 8%. Now, so taking into account all that, the current account as well as the capital account, we see the level of CBK usable foreign exchange reserves on August 9th to be $7.3 billion, which translates to about 4.01 months of import cover, which is in line with our targets. Let me turn now to fiscal performance and outlook. The 2022-23 government budget operations resulted in a lower budget deficit of 5.3% of GDP compared to 6.2% the previous year. Now, the ongoing implementation of the 2023-24 government budget continues to reinforce fiscal consolidation. A narrower budget deficit of 4.3% of GDP is expected in 2022 to 2024. Now, as a result of the identified new external financing, the projected net domestic borrowing by the government has been reduced from 586.5 billion to 316 billion. The revised borrowing requirements should exert downward pressure on domestic interest rates, while the additional external financing will bolster the international reserves of the central bank. Perhaps just to emphasize that point, which is that the National Treasury has identified new external financing, and this external financing is coming from multilateral institutions and also the regional institutions. And the import of that is that although it had been indicated that the Treasury would borrow 586.5 billion, because of the new external financing that has been identified, the National Treasury will now only be borrowing 316 billion. And I want to emphasize that because I think the market, our market, as well as foreign investors who are interested in what is going on in Kenya, have this idea that we are going to be borrowing 586 billion, which is a very large number, but in fact, now that number has been reduced to 316 billion. And we believe that with that reduced domestic borrowing, this would reduce the pressure on interest rates, and also it should be, because of the additional external financing, we should be able to have more foreign exchange, which will help us build our international reserves. And that build-up of international reserves also will help us meet external obligations, including the upcoming maturity of the Eurobond. And I do have here the letter from the National Treasury, which has confirmed that indeed they will only be borrowing 316 billion and not the much publicized 586 billion. Moving on to the next slide, which just to confirm the still ongoing fiscal consolidation. I think I've already mentioned these numbers. The fiscal deficit last year turned out to be 5.3% of GDP. The target for this year, 23-24, is 4.3. And then by the year 2025-26, that should move to 3.6. And that profile of the deficit, reduction in the deficit, should reduce the debt to GDP ratio. The debt to GDP ratio for up to June of this year, 2023, was about 62% of GDP. That is the net present value of debt to GDP was 62%. And which is higher than what the new limit that has been approved by Parliament. But the idea will be now to move from the 62% to that target of 55%. And I believe by the year 2026-27, we should have moved back to 55% of GDP, of the net present value of debt to GDP. Now, during the MPC meeting yesterday, and in line with the reforms outlined in the white paper on modernization of the monetary policy framework and operations, the MPC considered and approved a new monetary policy implementation framework designed to enhance monetary policy transmission. This new framework is based on inflation targeting and introduces an interest rate corridor around the central bank rate set at plus or minus 250 basis points. So henceforth, the monetary policy operations will be aimed at ensuring the interbank rate as an operating target closely tracks the CBR. In addition, to improve access to the discount window, the MPC agreed to reduce the discount rate from the current 600 basis points above CBR to 400 basis points above the CBR. Now, implementation of an interest rate corridor framework will align the interbank rate to the central bank rate and subsequently enhance the transmission of monetary policy to the short-term interest rates. Under the corridor framework, the CBK will conduct monetary policy operations within the objective of keeping the interbank interest rate within a prescribed band or corridor around the CBR. The functioning of the interbank market has improved as reflected in reduced segmentation and the narrowing of interbank interest rates spreads. The recently launched DAO CSD, the Central Securities Depository, is expected to further enhance the functioning of the interbank market. The effective operation of the interest rate corridor framework would require a well-functioning discount window facility, which serves as a backup source of liquidity for the banking system. The discount window plays an important role in supporting short-term liquidity pressures and thus promoting smooth operation of the banking system and implementation of monetary policy. Access to the discount window is collateralized and guided by measures aimed at ensuring the appropriate use of the facility. So the new framework, this demonstrates how the new framework is going to work. You can see that the green line is basically the CBR, and so 200 basis points up is the blue line, and 200 basis points lower is also now the lower band of that corridor. So basically, the idea would then be to have the interbank rate, which is represented by the purple lines, that remains within that corridor. And should it go outside, in other words, if there's a bank that cannot be able to get the liquidity that requires from the banking system, then it can then come to the central bank and then get their liquidity requirements or needs from the central bank. But it will then have to pay an interest rate, a penalty interest rate, which is the CBR plus 400, and that would be about 150 basis points above the upper end of the interest rate corridor. And we believe that this framework is going to be more efficient, more effective in terms of even the transmission of monetary policy decisions. So there will be a complete transparent framework for operationalizing the decisions of the Monetary Policy Committee. So, for example, in the event that at some point in the future we lower the CBR, then if you could maybe just go back to that chart. Yeah. Basically, everything now will shift down. And in that case, if we have to now, if the interbank rate is high, then what the central bank would do is inject liquidity to ensure that the interbank rate tracks the new lower CBR rate. And that's how we intend to really improve the transmission of monetary policy to the economy. I think with that, I thank you.
So thank you. That was the Governor of the Central Bank of Kenya, Dr. Kamau Thugge, going into a great deal of detail with regard to yesterday's Monetary Policy Committee meeting, some of the decisions made there and the resolutions, and what came out of that. But as usual, there are questions that have come in. Some of them, admittedly, have been partially answered as the Governor was giving his statement, but be that as it may, we will still put them up. And so we'll begin with David Herbling from Bloomberg News. And so David asks, when do you see Kenya offering a dollar-denominated bond locally, and what size are you looking at? Continuing, Brian Ngugi from the Standard newspaper, manufacturers say it remains a challenge to access dollars. This continues to have a negative impact on working capital for businesses. Brian is asking the Governor for his comment. Kefa Meirore, who is with the Business Daily, is saying that in relation to the new interbank interest corridor, noting interbank spreads had moved up to 900 basis points in some instances, how will the Central Bank of Kenya moderate the reset downwards? Lots more questions coming in, and we'll take them as we go along. Governor?
Thank you. I think with regard to the first question on when Kenya will be offering a dollar-denominated bond locally and what size, this is still an area that is under discussion. We will cooperate with the National Treasury as well as with maybe the banking sector. But having said that, I think it's important also to note that with the new Dow CSD, that even Kenyan diaspora will have access to these treasury bonds as well as treasury bills, and therefore the need maybe even for issuing locally a local dollar-denominated bond. We'll have to see whether that is still necessary. But I do believe that with the new system that we have put in place, that there'll be more people and more Kenyans abroad who will be able to access these securities, and therefore we should be able to increase our dollar, the dollar inflows into the economy. On the issue of the challenge of accessing dollars, we have been working on improving the interbank foreign exchange market. We will be having meetings with the banks to find a way and agree on a way forward. But the answer lies really in trying to restart and make more efficient the interbank foreign exchange market. With regard to the new interbank interest rate corridor, noting that interbank rates spreads had moved up to 900 basis points in some instances, and how will the CBK moderate the reset downwards? Of course, the framework had not been in place then. We are now putting the framework into play immediately with immediate effect. And so therefore, the upper, for you to access the discount window, we said it's 400 basis points from 10.5. So that translates to about 14.5 would be the upper end for the discount window. That means that the interbank rates cannot go beyond the 14.5 because any bank that cannot be able to access liquidity and has to pay a higher price beyond the 14.5 can then access the central bank window at 14.5. So that's why. So the short answer to your question is that the framework was not in place, but now that we have it in place, we should be able to manage the interbank rates to not to exceed the 400 basis points that we have indicated.
We continue with our questions, and this time there's 1, 2, 3, 4 people asking largely the same question, but I'll read each of them in turn. Stella Swakey from the Standard Investment Bank says, is a country depending on the IMF as anchor lender to meet financial year 23-24 external borrowing targets? We noticed that the target increased from the earlier estimates. Kefa Moirore from the Business Daily on a related note, what are the new sources of external financing in the domestic borrowing target revision? And does the central bank see improved access to international capital markets? Ramanyang from CGTN Africa, the MPC statement referred to new external financing. Are you able to provide more details on the source, tenor, and interest rate of this facility or facilities? Finally, on this particular question, Charles Moneki from the Business Daily, the MPC release spoke of new external financing that has led to the cut in the domestic borrowing target. Is it commercial or concessional, and how much is it? On a different note, Ramanyang again from CGTN Africa, from the central bank's perspective, what caused the spike in interbank lending rates last week to averages of 16 to 17%? Finally, in this set of questions, David Herbling from Bloomberg News, what is your take on Kenya's plan to buy back its $2 billion 2024 Eurobond, and what effect will this plan have on foreign reserves?
Okay, I think indeed they are quite similar questions. As I said, we have engaged with the National Treasury, especially just to agree and understand on the external borrowing requirements and the sources of that external financing. What I can say is that financing would be largely from multilateral institutions, both international multilateral institutions, as well as regional institutions. So to that extent, that funding will be concessional, roughly concessional, but there's also some that we intend to access, or the Treasury intends to access, perhaps through, it may not be so concessional. But essentially, the sources of financing have been identified, and that is why the National Treasury has indicated to us that their borrowing requirements have now been reduced from 586 to 316. Now, of course, the IMF, we do have a program with the IMF, so IMF is will be a part of the contribution for that external financing. But the IMF financing was already known, so the IMF is not one of the new sources of financing. Perhaps at some point the Treasury can provide a bit more details, but in several cases they've already signed the agreements, so that these external financing will start to flow soon. And maybe I can also tie that with the question on the Eurobond, because what we're expecting is a significant inflow between now and December. On the how we are going to deal with the Eurobond, of course, we are identifying the lead arrangers. That discussion about the modalities, how we are going to do it, is still ongoing. But suffice it to say that we will have enough international reserves to be able to deal with the Eurobond from even a cash point of view. If the market does not behave by next June, I believe we will have enough reserves to be able to pay all those people holding the Eurobond. I think indeed there was a spike in the interbank lending rates, and that was part of our tightening of monetary policy. We have since brought back the interbank rate to about to the middle of this, actually very close to the CBR. And so we are already implementing this monetary policy framework, because now the interbank rate and the CBR are very much tracking one another. I think that's it.
Going to the third batch of questions, we start with Harold Allo from the People Daily. Harold is asking, how is the progress of mobile money interoperability? Are some players sabotaging the process, and what is the Central Bank of Kenya's stake? Back to Rama, interesting question. Going forward, will CBK provide details on how individual MPC members voted as part of the MPC statement or in the post-MPC press conference? We have Brian Goge from the Standard newspaper. Brian is asking, the lithium shilling is making your fight, I presume the central bank's fight, to curb inflation harder, given Kenya's imports dependence. Is this your Achilles heel against inflation, and what is your outlook?
Let me start with Brian Goge's point about the the weakening shilling and its impact on inflation. Indeed, there is a link. Obviously, when the shilling weakens, then imported items also become expensive, and that does give us a challenge on the inflation front. But having said that, indeed, as we have indicated, inflation now is within our range. It's now at 7.3, despite the depreciation that we have experienced with the shilling. And so, yes, but it does not mean that we cannot address the inflation issue, as we indeed we have, and have now been able to at least bring the inflation rate to within our operating range. I think going forward, we do expect, as I said, the current account is improving. The balance of payments will be in surplus, and I think now also with potentially the pausing of raising of interest rates by the US, we should see perhaps less pressure on the shilling, and so we don't really see the weakening of the shilling being a major challenge in terms of us addressing the inflation rate. About the CBK providing details on how individual MPC members voted, that's not an issue we have discussed yet, so I can't give an answer to that. But it will be interesting to see how the other members of the committee feels about this. I know in other central banks that is done, but we don't have a position at the moment. I'm not sure about whether there are members who are sabotaging the process on mobile money interoperability. And so I would hate to go into that question, because I am not aware of those players who may be doing that.
All right, thank you, Governor. The final batch of questions, back to familiar voices, Stella, David, and Kefa Moirore. Beginning with Stella Swake from the Standard Investment Bank. She asks, how is the Central Bank of Kenya ensuring the agility and effectiveness of open market operations? The last couple of days have been highly volatile, with rates up to 18% for 4-day reverse repos. That may already have been answered, but the governor is free to handle that again. David Herbling from Bloomberg, why is Endow CSD integrated with mobile money platforms to allow easy access and investment into government securities by hustlers? Kefa Moirore from the Business Daily, finally, Kefa says he's curious about CBK's stance on the exchange rate. Flexibility has been allowed as a cushion to external shocks. Is the current rate accommodative enough?
Okay, I think the question from Stella, this framework, the framework we have now put in place will help us reduce the volatility of the interbank rates. I think in addition, just to add, the new system, the new Endow CSD, has now provided the banking system with a platform where they can more trade with or lend to one another using securities, and therefore has deepened the interbank market, has reduced segmentation, because now the small banks and the large banks, they can lend to one another as long as they have securities. And so that we should expect now to see a fairly narrow range of the interbank rates. And now with our interest rate corridor and the new window, the new overnight window, well, actually we should be able now to see reduce significantly the volatility in the interbank rate. we should not see the kind of volatility we had in the last few days. As far as I'm aware, the Dow CSD, it's very easy to invest in government securities by hustlers. I think all you need is a bank account, and that's it. And you can access the Dow CSD from your phone, from your computer. It's actually as simple as that. On the issue of the exchange rate, whether flexibility has been allowed as a cushion to external shocks, I mean, definitely the flexibility of the exchange rate helps in terms of providing a cushion against external shocks. We will obviously continue to have a flexible exchange rate system that will reflect the underlying demand and supply. But yes, indeed, having that flexibility, particularly as we target our international reserves, will help us cushion against external shocks. Thank you.
Thank you very much. That brings us neatly to the end of today's and this month's post-MPC press conference. A few final notes is, as usual, the MPC has indicated plans to meet again in 2 months. That is at the beginning of October. But if there's any need, the MPC obviously convenes as and when required. Again, some notes. There is a press release that was issued this morning with regard to the issues of the interest rate corridor and all that the governor has described. Those are available on all our platforms, that is on our websites and our social media platforms, including Facebook, Twitter, now known as X. There's WhatsApp channels and all those. You can see those press releases and read them for yourselves. And additionally, all the material coming out of the Monetary Policy Committee, this is their surveys and any other material that is coming out of the MPC for public consumption will be made available on those same channels, hopefully by the end of the week, that is tomorrow, and you're able to interact with these materials as and when you need to. But otherwise, from the Central Bank of Kenya, thank you very much, and see you at the next one.